Have you ever wondered how much money you'd need to invest to earn an extra $3,000 every single month? That's $36,000 a year just from your investments. It sounds like a dream, right? Living off your portfolio, covering your bills, or just having that extra cash for whatever you want. Well, today, we're going to break down exactly what it takes to make that dream a reality. We'll explore different investment strategies, the returns you can expect, and the magic number you need to hit. Stick around because by the end of this video, you'll have a clear, actionable roadmap to generating that passive income. First things first, let's get the core math out of the way. The amount of money you need depends entirely on one crucial factor: your annual rate of return. This is the percentage your investments grow each year. A higher return means you need less initial capital, and a lower return means you need more. To calculate the total investment needed, we use a simple formula. Take your desired annual income and divide it by your expected annual rate of return. In our case, the desired annual income is $3,000 a month, which is $36,000 a year. So, the formula is $36,000 divided by your rate of return. Let's plug in some numbers and see what this looks like in the real world. Let's start with a very conservative approach. Imagine you put your money into something extremely safe like high-yield savings accounts or government bonds. Historically, these might offer a return of around 2% to 4% per year. Let's be optimistic and use a 3% return. Using our formula, we take $36,000 and divide it by 0.03. The result? You would need a whopping $1.2 million invested. Yes, you heard that right, $1.2 million. For most people, that's a huge amount of money to accumulate. While this path is incredibly safe and your capital is well protected, the high capital requirement makes it less practical for achieving our goal quickly. It's a good option for preserving wealth once you have it, but not necessarily for building it. Okay, so what if we're willing to take on a bit more risk for a better return? Let's talk about the stock market. A popular and relatively simple strategy is investing in index funds that track the entire market, like an S&P 500 index fund. Historically, the S&P 500 has returned an average of about 10% per year over the long term. However, it's wise to be a bit more conservative in our planning, because past performance doesn't guarantee future results. Let's plan for an average annual return of 8%. Now let's run the numbers again. We take our $36,000 annual income goal and divide it by 0.08. This gives us a total investment of $450,000. That's a much more attainable number than $1.2 million, isn't it? It's still a significant amount, but it feels more within reach for someone who's diligently saving and investing over time. This brings us to a key concept many investors use: the 4% rule. The 4% rule is a popular guideline for retirees. It suggests that you can safely withdraw 4% of your initial portfolio value each year, adjusted for inflation without running out of money for at least 30 years. If we flip this rule on its head, we can figure out our target portfolio size. To find the total amount needed, you multiply your desired annual income by 25. Why 25? Because 1 divided by 0.04 is 25. So for our goal of $36,000 a year, we multiply that by 25. And what do we get? $900,000. Now you might be thinking, wait, that's double the $450,000 we just calculated with an 8% return. And you're right. The 4% rule is designed for capital preservation and longevity, especially in retirement. It builds in a significant buffer for market downturns and inflation, ensuring your money lasts. An 8% withdrawal rate might deplete your principal much faster if the market has a few bad years. The 4% rule is the safer, more sustainable withdrawal strategy for the long haul. Now let's explore another popular avenue for passive income: real estate. Earning $3,000 a month from rental properties is a very common goal for real estate investors. The amount of capital you need here can vary wildly depending on your market, the type of property, and how you finance it. Let's say you want to buy a property outright with cash. The 1% rule is a common guideline in real estate, suggesting a property should rent for at least 1% of its purchase price each month. But here's where real estate gets interesting: leverage. Most people don't buy properties with all cash. They use mortgages. Let's say you buy a $500,000 property with a 20% down payment, which is $100,000. After your mortgage payment and all other expenses, you might be left with a few $100s in cash flow per month. To reach $3,000 in monthly cash flow, you'd need to replicate this several times. You might need to buy 5 or 6 similar properties, which would require a total down payment of $500,000 to $600,000. So, while the total value of the real estate is high, the actual cash you need to get started is similar to our stock market example. The trade-off is that real estate is not passive, it's a hands-on business. You're a landlord, and that comes with its own set of challenges. So we have a few target numbers: $1.2 million for a super safe 3% return dollar, $900,000 for the conservative 4% withdrawal rule, and around $450, zero for a more aggressive 8% return strategy or for getting into real estate with leverage. These numbers might feel intimidating, but remember, you don't need to have this money today. The key is to start building towards it. The power of compound interest is your best friend. For example, if you start with zero and invest $500 a month, earning an average 8% return, you could reach that $450,000 goal in about 30 years. If you can invest $1,000 a month, you could get there in just over 21 years. The sooner you start, the less you have to invest out of your own pocket, because your money starts working for you. Let's also touch on dividend investing. This is a strategy where you focus on buying stocks of companies that pay out a portion of their profits to shareholders, called dividends. To get $3,000 a month or $36,000 a year, you'd need a portfolio that yields a certain percentage. A typical dividend yield for a diversified portfolio of blue-chip stocks might be around 3%. Using our formula, $36,000 divided by 0.03 gives us that familiar $1.2 million figure. However, some investors actively seek out higher yield stocks. Ultimately, there's no single magic number. The amount of money you need to invest to make $3,000 a month depends entirely on your chosen strategy, your risk tolerance, and your timeline. For the ultra-cautious, you might be looking at over $1 million. Thank you so much for watching. I hope this breakdown was helpful and gave you a clearer picture of what it takes to build a significant passive income stream. If you got value from this video, please hit that like button and subscribe for more content on personal finance and investing. Let me know in the comments which strategy you find most appealing. See you in the next video.